Welcome to Investment 360. First up this evening, Michael Dodd, investment analyst at Acsis in Cape Town. My co-host Ashraf Mohammed from Regiment's Fund Managers still in studio. Michael, thank you very much for your time. We're talking about asset allocation right now, and I think that it's possibly fitting for us to start in terms of what you are advising clients to do when it comes to asset allocation. I know that diversification is a big theme in your book.
It is, and I think it's probably fairly important to start out getting an understanding of what asset allocation is, and what asset allocation is essentially is it's getting that right mix of asset classes right across your portfolio. So investing in, your equities, your bonds, your property, and also getting your offshore exposure as well, and really just getting that and getting the right mix of that to ensure that the clients are able to achieve their investment goals over the long term.
Michael, the asset allocation varies from one client to the next depending on their liability profile. When you're looking at asset allocation for a particular individual who's about to retire, how would you advise, let's say, a 63-year-old right now in terms of asset allocation?
No, you're absolutely right, Ashraf. And I think your asset allocation is very much determined by a number of circumstances. It's determined by what your return needs are, what your risk tolerances are, and so your older investor or your 63-year-old investor who's currently close to retirement, bordering on retirement, is going to be an investor that is going to naturally want to take on a lot less risk than that of a younger investor who's going to be able to currently, sit through the current market volatility and ride the ups and downs that the market currently gives you. So for your older investor, you would naturally assume that investor would have a lower allocation or lower exposure to your riskier assets, to your growth assets, and would have probably more of a focus on capital preservation and have that kind of a bias.
Michael, earlier Andrew Cantor from Future Growth made the point that we've seen incredibly volatile equity markets of late. How do you view volatility? Do you think that volatility brings opportunity?
I think that's a fairly accurate statement. I think history has kind of shown us that over time and through periods of higher volatility, that's the time where you've been really presented with that sort of opportunity, the opportunity to buy better quality assets at lower prices as equity markets have come down. So times of high volatility as well is also, it makes markets a fairly emotional place to be. And for your investors, and especially in this day and age where you're able to go online and check your statement on a day-to-day basis, and you can see your portfolio fluctuations and that sort of thing, it means that it makes you more emotional, and it gets you more involved in noticing what's going on in your portfolio on a day-to-day basis. And it's at those sorts of times that investors can make your irrational decisions that can often be wealth destructive. And it's at those sorts of times where people try and adopt a market timing approach. And you'd love to be able to go out there and buy the bottom and sell the top, and buy the absolute lows, sell the highs. And the fact of the matter is that without perfect foresight or some sort of crystal ball, most investors aren't going to be able to get that market timing thing right.
Michael, Reg 28 is now come into play. How has that affected the advice that you've given to your pension fund clients?
Well, with Regulation 28 and the changes that we've seen to Regulation 28, and what those changes have allowed us to do is it's allowed us a wider range of asset classes within which we can use in our portfolio construction. It gives investors not just the access to your traditional bonds, equities, cash, and offshore, but also has sort of widened the range and widened the scope to include your alternative asset classes, to include things such as private equity, include things such as hedge funds, allow an allocation, a small allocation to Africa, and really just allows investors to push out the efficient frontier and really enhance your risk return profile.
What are your thoughts on South African equity valuations currently? And let's drill down into some of the opportunities that you potentially see.
Oh, I think when you look at your South African, your valuations, and you look at it across asset classes, you've got to look at them relative to their history, first of all, and relative to your long-term expectations, but also look at how they sit relative to your other asset classes. So South African equity markets, and Ashraf, you can correct me if I get this wrong. The last number I checked, and with markets moving around the way that they are, this number may be different, but are currently on a forward earnings yield of around 9%, and that relative to their history and what you'd assume is a long-term assumption for South African equities, means that South African equities are looking slightly attractive at the moment on a relative basis.
Ashraf, can I get your thoughts on that? Do you agree?
Like I said, sorry.
Michael, I'm just getting Ashraf to comment here. We're coming back to you. Just to hold 10 there.
Absolutely. On a 2 to 3 year view, I think our equities are very attractive, but expect volatility in the interim on an upward trend.
Michael, I'm throwing it back to you in Cape Town there, just getting Ashraf's thoughts on your sentiments around equities.
I'd agree 100%. I think looking at the current market situation and how virtually every market move that we've seen over the course of the last few weeks has really been sentiment and news flow driven. I don't think the volatility is going away anytime soon. And the nature of the South African markets is that South Africa is going to be led by what's happening globally to a certain extent as well. They say when America sneezes, the world catches a cold, and that happens in equity market moves as well.
Yeah, Michael, Ashraf here. Right now we've discussed how cheap equities are, but on a relative basis, our bond market is looking quite expensive, especially when you consider where long-term inflation is. In terms of asset allocation, would you be cutting aggressively out of fixed income and into equities, or do you think it's too soon?
I think the way that we would currently be positioned and how we currently see things is that I do agree with you, and at risk of upsetting Andrew Cantor, who's a fixed income man who was sitting in this chair about 5 minutes before I was, but your fixed income valuations, and you've got to take into account the current market environment that we're in. As Andrew said previously, we have markets currently pricing in the possibility of a future or a potential rate cut. You've got your expectation that rates both locally and globally are going to remain lower for longer, and with your rising inflation and the environment that we currently find ourselves in, investors are going to be faced with the possibility that within a few months' time, as inflation rises and interest rates remain at the same level, they're going to be faced with the very real possibility of negative real interest rates. And what that means for investors who are potentially looking for returns to beat inflation is that cash it isn't going to cut it. So I wouldn't say that we'd be aggressively cutting out of fixed income, but we would favor an overweight to your riskier assets and underweight to fixed income, as we don't really believe it's a time to be taking risk off the table at the moment.
So just to clarify there, specifically overweight towards equities?
Specifically overweight, and it would be a slight overweight on the local side, but where we're seeing a lot of value as well is in your global equities and also with your global exposure. You've got I mentioned the 9% forward yield of the South African or the South African equity market. But if you look at the forward yields of things such as the MSCI World Index, given the recent market moves, that's on a 1-year forward yield of around that's way too high, about 9.4, 9.5%. And you look at it in the context of the global environments as well, where you've got your lower interest rates, you've got your US 10-year bond yield is currently yielding around 2%. And you compare that to the between 2.5% to 4% dividend yields that you can get on global blue chip companies that you could probably argue have a way stronger balance sheet than the sovereigns themselves.